Have you ever lost your email password? It's annoying, sure, but generally solvable. You hit recover, answer a couple of questions, and you get a new one. Now imagine a world where that button doesn't exist. You forget your password, and everything linked to that account is gone forever. Your money, your documents, your entire digital life. And the scariest part? No one can help you. No tech support, no government, no court of law. Because in this world, there is no center. There is no company that owns the system. There is only code that runs itself. And this world already exists. There are $3.5 trillion spinning inside it. Billions of transactions pass through it every day. It has banks without bankers, contracts without lawyers, exchanges without owners. Machines lend money to machines, and algorithms manage fortunes. And all of this happens without a single human being who could hit the stop button. They call it Web3. They say it's the future of the internet, that it will return control of data and money to the people, that it will free us from the dictatorship of corporations. But right now, it looks different. Hackers from North Korea are stealing billions to fund a nuclear program. People lose everything in a split second because of a single bug in the code. And entire ecosystems collapse in a week, wiping out billions of dollars. And yet, the very corporations Web3 promised to free us from are already here. BlackRock is managing hundreds of millions inside the system. JPMorgan is launching its own blockchain projects. Visa is processing crypto payments. So, what is this? A revolution changing the rules of the game, or an experiment that has spiraled out of control? To understand how we ended up here, we need to go back 30 years, to a time when the internet was just being born and looked completely different. In the early 90s, at its dawn, the internet was simple. This was Web 1, the first generation of the World Wide Web. Back then, the network was built on a read-only principle. Static pages, minimal design, no profiles, no data about you. Everything you saw belonged to the authors, not companies. But in the mid-2000s, everything changed. The term Web 2 appeared, an internet where users didn't just read, they created content. If Web 1 was a display window, Web 2 became a town square for communication and interaction. The main symbol of this new era was Facebook. Mark Zuckerberg launched it in 2004 for Harvard students, and soon, for the whole world. Facebook didn't invent social networks, but it made them part of daily life. Billions of people voluntarily filled the platform with their photos, thoughts, and connections, receiving nothing in return but the feeling of being part of something bigger. At first glance, it looked like a revolution. It seemed that finally everyone had a voice, a chance to be heard, and a way to share what mattered. But hidden behind this freedom was a deal. Terms and conditions almost no one read. By publishing a photo or a post, you gave the platform the right to use it however they wanted, for ads, for training algorithms, for analyzing behavior. In exchange, you got likes, an illusion of recognition that kept you coming back again and again, and the more time we spent on the platform, the better it got to know us. Algorithms studied what we watched, how many seconds we lingered on a post, and what triggered our emotions. This information allows them to predict our behavior and sell our attention to advertisers with terrifying accuracy. In March 2018, the internet's mask fell off. The Guardian and the New York Times published an investigation that sent chills down everyone's spine. The personal data of 87 million Facebook users had ended up in the hands of the political consulting firm Cambridge Analytica. How could this happen? It was simple. In 2013, a psychologist named Alexander Kogan from Cambridge University created an app with the innocent title, "This is Your Digital Life." It was a simple personality test that paid people to take it. About 300,000 people installed the app. But the catch was this. The app collected data not just from those who installed it, but from their Facebook friends too, automatically and without consent. Just like that, Kogan gained access to the profiles of tens of millions of people. Their likes, posts, private messages, and even their location. Kogan sold this data to Cambridge Analytica, and they, in turn, literally weaponized it. Based on likes and posts, algorithms built psychological profiles of voters. Who is anxious, who is short-tempered, who is susceptible to fear. Knowing this, they showed users specific ads, specific slogans, and specific emotions. Cambridge Analytica worked on Donald Trump's election campaign and for the supporters of Brexit. Millions of people saw a different reality, one tailored to their weaknesses. It turns out the internet, which promised to connect us, became a tool for manipulation. When this came to light, a massive scandal erupted. Zuckerberg was summoned to the US Congress. Facebook stock plunged 20% in a week. The company was fined $5 billion. It was the largest fine for a privacy violation in history. But here's what's truly important. Nothing fundamentally changed. Because the problem isn't that Facebook broke the rules. The problem is that the rules inherently allow private corporations to own other people's lives. You think your photos in Google Photos belong to you? But an algorithm can lock your account without warning, just like it happened in February 2021. A San Francisco resident named Mark noticed an inflammation in his young son's groin area. Due to the pandemic, doctors were consulting online, and a nurse asked him to send a photo for a preliminary check. Mark took a picture of his son on his phone and sent it through the medical portal. The photo automatically uploaded to Google Photos as a backup. 2 days later, the algorithm banned his account permanently. It recognized the medical photo as prohibited content and sent a report to the authorities. The police, of course, closed the case, and doctors confirmed it was legitimate, but Google refused to restore the account. 10 years of emails, photos, and contacts vanished forever. The rest of the internet works the same way. Essentially, you can use a platform for work for years, talking to clients, storing your portfolio, managing projects, and lose access in a moment for violating rules that change every month and are interpreted by an algorithm. By the early 2020s, the situation had become absurd. 5 companies controlled almost everything we saw, read, and bought. Google processed 92% of global search queries. Facebook connected nearly 3 billion people. Amazon owned half the cloud infrastructure that websites and apps ran on. And Apple decided which programs could exist on your devices. And what's even scarier, now they decide what exactly you are allowed to say. In January 2021, Twitter, Facebook, and YouTube simultaneously banned the accounts of the sitting president of the United States. 3 private companies made a decision without courts or votes, simply because they had the technical power to do so. At first glance, they just removed a user. But in reality, they shut off the voice of a man listened to by 150 million people. It turns out the internet was conceived as an open space, common to all, without censorship or top-down rules. But over time, it turned into a network of closed platforms that control everything: data, attention, and even what a person can say. And when people realized this, a reasonable question arose. Can a different internet exist? One where you actually own what you create, where platforms don't dictate the rules, and where control returns to the users? It was at this moment that the idea of Web3 stopped being an abstract fantasy of programmers and turned into a movement. Let's transport ourselves to 2021. The world is just coming out of lockdown, central banks are printing money by the trillions, interest rates are zero, and people are sitting at home looking for somewhere to put their savings. Suddenly, the internet explodes with stories of people becoming millionaires overnight by buying a digital picture online. On March 11th, 2021, Christie's, one of the world's oldest auction houses, where they sold Picassos and Monets, puts a file up for auction. Not a canvas, not a sculpture, but a JPEG image. The work is called Every Days, the First 5,000 Days, a collage of 5,000 drawings by an artist under the pseudonym Beeple. The starting price is $100. The bidding lasts 2 weeks. You won't believe it, but the final bid was $69.3 million. Just think about that number. That is more than Monet paintings at the same auction. More than some works by Van Gogh. And the strange thing is, the buyer doesn't receive a physical object, but a token on the blockchain. A record stating they are the owner of the original. Anyone can copy the file, but the token belongs only to them. Beeple, who was almost unknown outside a small circle of digital artists, became the 3rd most expensive living artist in the world overnight. And that was just the first wave. The real phenomenon became the Bored Ape Yacht Club, a collection of 10,000 images of monkeys in different outfits and accessories. In April 2021, you could buy an ape for $200. By the end of the year, the floor price reached $400,000. But it wasn't about the pictures. Owning a Bored Ape meant a ticket to a new digital elite club with virtual parties, meetups with celebrities like Snoop Dogg, and the right to use the image in commercial projects. Some opened restaurants under their Apes brand, others made TV shows and merch. In 2 years, the trading volume of NFTs from this collection exceeded $2.5 billion. Global brands from Adidas to Nike released their own NFT collections and made hundreds of millions. However, NFTs were just the beginning. Riding their wave, a new phenomenon appeared: play to earn, games where you could earn real money. The most famous was Axie Infinity, a world of cute creatures called Axies, which you bought as NFTs, bred, and sent into battle. For victories, players received in-game currency, which could be exchanged for dollars. In the Philippines, people quit their jobs to play Axie. Documentaries showed families for whom the game became their main source of income, earning around $300 a month, more than the minimum wage in the country. By the summer of 2021, 3 million people were playing Axie simultaneously. Trading volume exceeded $4 billion. It looked like a new economy, but under the hood, it was a pyramid. New players bought NFTs from old players, propping up prices. When the influx of newcomers slowed down, everything collapsed. The game token lost 99% of its value in 6 months. The price of an NFT Axie fell from $200 to $5. And those who quit their jobs for the game were left with nothing. While some were losing money on play to earn, the world had already been infected by the next idea: metaverses. Virtual worlds where people work, relax, and even own real estate. The Sandbox and Decentraland sold digital land. Plots went for hundreds of thousands of dollars. Total sales exceeded 500 million. Brands held fashion shows and concerts there. It all looked like either the future or an episode of Black Mirror. And then came 2022. Inflation in the US and Europe hits record highs. Central banks sharply raise interest rates. Cheap money dries up, and with it goes the speculative capital that held up the crypto economy. Investment flows run dry, and suddenly it turns out the metaverses are empty. Decentraland has only 8,000 daily users compared to 5 million in Fortnite. In the end, it turned out that virtual land bought for $500,000 was now wanted by no one. NFT prices collapsed. A Bored Ape that cost $400,000 fell to $30,000. Most collections lost 90% of their value. And the total volume of NFT trading shrank from $25 billion a year to 8. And here, a rational question arises. What was that all about? Mass hysteria, ending in a predictable crash? Or was it an experiment that showed the technology works, but arrived too early? Because if you look closer, not everything collapsed. NFT tickets for concerts and sports events are still being used. The NBA sold millions of them. Brands didn't leave either. Starbucks launched a loyalty program on the blockchain where users get NFT badges for purchases. Reddit released 18 million digital avatars, and most users don't even know they are NFTs, just collectible pictures they can trade. Maybe the problem wasn't the technology, but how it was used. People bought NFTs not because they liked the pictures, but because they hoped to resell them for more. They played Axie not for fun, but for profit. It would seem this is where the story should end. The bubble burst, the market burned out, millions lost money. Everything should have imploded, but that didn't happen. While some were counting their losses, others noticed something strange. The money didn't disappear. It just flowed into a different channel, one where you don't see brand logos or advertising slogans. A place where banks, lawyers, and middlemen aren't needed, where power belongs to the code. And that is exactly where the next chapter of this story begins. On March 23, 2022, a developer for the game Axie Infinity receives an email with a job offer. The position looks attractive and a PDF with details is attached. He opens the file. Nothing happens. 9 days later, it becomes clear that Axie players cannot withdraw their money. An investigation begins, and soon it is revealed. $540 million have vanished from the Ronin network, the system linking the game to the blockchain. That PDF file turned out to be a virus through which hackers gained access to the network. They compromised 5 out of 9 validators, special nodes that confirm transactions, and that was enough to drain all the funds. The tracks lead to Pyongyang. The Lazarus Group, working for the North Korean government, according to the UN, used the stolen money to finance their nuclear program. The Lazarus Group is well known in the crypto world. Before the attack on Ronin, they hacked the Japanese exchange Coincheck, stealing $530 million. Later, they got to Harmony Horizon, a so-called bridge between different blockchains through which users transfer tokens. Another 100 million disappeared from there. In total, Lazarus is linked to thefts of more than $1 billion. And this is just part of the picture, because in 3 years, about 270 major hacks occurred in the Web3 ecosystem. Total damages exceeded $10 billion. For example, after the wormhole bridge hack for $325 million, the company Jump Trading covered the losses from its own funds, keeping the Solana ecosystem afloat. But soon, a new hack happened. A bug was found in the code of the Nomad bridge, and a user published how to exploit it. Mass looting began. Hundreds of people copied the exact same transaction, changing only the recipient's address. In a few hours, $190 million disappeared from the network. And these stories are just a small fraction. Phishing, fake airdrops, hacks, plus the human factor. Americans lost $1.5 billion in Bitcoin due to lost keys. Web3 promised freedom without intermediaries. In practice, this means you are your own bank. And yes, that is risky. But here is what matters. Every hack makes the system stronger. Insurance protocols for smart contracts have appeared. Audit firms check code before launch. Wallets are adding multi-factor protection. The industry is learning. Yes, painfully and publicly, but it is learning. And unlike traditional banks, where after a collapse everyone is bailed out by taxpayer money, here the code either survives or disappears. While some lost money speculating on NFTs and others fell victim to hacks, something more important was happening in the shadows. In countries with unstable economies, people began using Web3 not for profit, but for survival. In Turkey, inflation hits 80% a year. The lira devalues so fast that a salary received on Monday is worth less by Friday. Buying dollars is hard. The government restricts currency exchange, so people started switching to stablecoins, digital tokens pegged one-to-one with the dollar, for example, USDT and USDC. Today, they make up almost a third of all crypto turnover in the country. This isn't investing. It's a way to protect oneself from devaluation. In the Philippines, Web3 is solving a different problem: money transfers. Workers who moved abroad send funds to their families. Previously, this was done via Western Union with commissions up to 15% and a week-long wait. Now it happens increasingly through USDC. The commission is less than 1% and the money arrives in minutes. In the second quarter of 2024, $8.5 trillion passed through stablecoins, more than Visa processed in the same period. It's worth understanding that stablecoins aren't pure Web3, but they run on the blockchain. And they prove the main point. If technology solves a real problem, people will start using it regardless of whether they understand how the blockchain works or not. Alongside this, a whole layer of infrastructure grew: DeFi, or decentralized finance. These are systems that work without banks or managers, 24 hours a day, 7 days a week. But how is that even possible? The answer is simple: blockchain and smart contracts. To understand how it works, imagine a ledger where every line is a transaction. Who transferred how much to whom? Now imagine that a copy of this ledger is stored by thousands of people around the world. If someone tries to change one entry, the other books will show it's a lie. This is how the system protects itself. Without guards, without a bank, without a central server, and a smart contract is the next step. If the blockchain stores records, the smart contract executes rules. It is a program that executes an agreement automatically. In a normal bank, a manager checks the application, a lawyer writes the contract, and an accountant transfers the money. In Web3, code does all of this. You put up collateral, you get a loan. If you don't pay it back, the system automatically sells the collateral and closes the debt. No calls, no delays, no human factor. The entire DeFi industry is built on these principles. For example, the decentralized exchange Uniswap processes $2 trillion a year. The smart contract platform MakerDAO manages $9 billion, without an office, without employees, without bosses. And what is especially telling, when the FTX exchange went bankrupt in 2022 and dozens of centralized exchanges collapsed, DeFi protocols didn't stop for a second. Uniswap continued swaps, the Aave protocol issued loans, smart contracts executed code. No one could turn them off, and no one could steal other people's funds. This is the main difference of decentralization. The system works regardless of what happens around it. Gradually, traditional finance began eyeing this technology. Take BlackRock, for example. This is the largest asset management company in the world, with assets of $13.5 trillion, and it launched an entire fund on the blockchain, tokenized US Treasury bonds. Investors buy tokens and get about 5% per annum. By the end of 2023, the fund already had $500 million. And JPMorgan is creating JPM Coin, a token for instant settlements between corporate clients. Over $10 billion passed through it in a year. The very idea of tokenization, that is, moving real assets onto the blockchain, is also becoming a new growth area. Why do all this? Simple. For transparency, speed, and accessibility. Imagine, you want to invest in commercial real estate, but you don't have $1 million. Before, this was impossible. Now, ownership of a building is divided into thousands of digital shares, and you buy your part for $100. Rent is automatically distributed among all owners via a smart contract. No management companies, no delays in money transfers. Such platforms are already working. Realty has sold tokens for American real estate worth $150 million. Investors receive dividends every day, automatically in stablecoins. And in Africa, smart contracts are already working to ensure crops. When satellites detect a drought, the code automatically transfers money to farmers without bureaucrats or delays. Yes, all this is still a tiny part of the global economy. DeFi manages about $120 billion. That's like one large American bank. But the trend is obvious. The world's largest financial institutions are starting to build the infrastructure of the future. Visa processes crypto payments, MasterCard tests central bank digital currencies. The European ECB is developing a digital euro. Web3 has stopped being a story about hype and speculation. It is becoming part of the global financial system, slowly, with mistakes, through crises and hacks, but it is becoming one. But as soon as the technology started processing trillions of dollars, a new question appeared. Who sets the rules in a system created to be without rules? While BlackRock and JPMorgan were building bridges between the old financial world and the new one, governments watched what was happening with growing anxiety. Because a technology that allows billions of dollars to be transferred without control is a challenge to a system that has existed for centuries. The US was the first to sound the alarm. In 2021, SEC Chair Gary Gensler declared the crypto market the Wild West and promised to bring order. The SEC filed lawsuits against the largest exchanges, Binance and Coinbase. Cryptocurrency capitalization fell by $100 billion in a day. But a month later, the court dismissed part of the charges, acknowledging the legislation was not clear enough. It's a stalemate. The regulator tells exchanges this is illegal, and the court replies it's unclear exactly what is illegal. Europe chose a different path. In June 2023, the Messier regulation came into force, the world's first comprehensive law on cryptocurrencies. It states that stablecoins must have full reserve backing, exchanges must get licenses, and companies must publish documentation on risks. The rules are strict but clear. This kills part of Web3's anonymity but gives legitimacy. For example, European pension funds can now officially invest in crypto assets. China, however, acted radically. In September 2021, Beijing declared all cryptocurrency transactions illegal. The country, which controlled 70% of the world's Bitcoin mining, exited the game in a month. The reason is simple. The state is launching the digital yuan, the first fully electronic currency of a major economy. By the end of 2023, 260 million people were already using it, and transaction volume exceeded $250 billion. China proved that blockchain can be used to strengthen control, not weaken it. But the strangest case occurred in August 2022. The US Treasury Department sanctioned Tornado Cash, a protocol for private transactions. $7 billion were laundered through it, including money from North Korean hackers. But Tornado Cash isn't a company. It is code running autonomously. A week later, Alexei Pertsev, one of the developers, was arrested in Amsterdam. He was accused of aiding money laundering. The defense argued he wrote the code and published it as open source, but he didn't control its use. It's like accusing the inventor of the knife of murder. In May 2024, the court sentenced Pertsev to 5 years in prison. A paradox arises. Governments cannot tolerate tools for laundering billions, but technically, it is impossible to ban code on a decentralized blockchain. You can arrest the developer, but the smart contract will continue to run on thousands of computers. While some countries fight cryptocurrencies, others invite them. The UAE, Singapore, and Switzerland are already issuing licenses and creating free crypto zones. Technology flows to where there is less resistance, and governments are learning to control what was created without control. But the main question remains, what will come of all this? Once, the internet promised to liberate humanity, to give a voice to everyone, and then corporations turned it into a marketplace for attention. Now Web3 promises to return to people what they lost, the right to own their data, their money, their digital self. But let's be honest, the early years of Web3 were chaos. Every month a new hack, every quarter a new crash, and every year a new lesson. The technology learned on live money and real people, brutally, publicly, and painfully. But that is exactly how systems that survive are born. Maybe that is the point. Traditional systems break too, banks go bankrupt, exchanges fall, currencies devalue. But there, everything is hidden behind closed doors, while here, everything is visible. Every hack, every mistake, every failure is out in the open. And interestingly, despite all this chaos, people continue to use Web3. In Turkey, they escape inflation through stablecoins. In the Philippines, they transfer money to families without banks. In Africa, they insure crops via smart contracts. And BlackRock and JPMorgan are building new financial infrastructure on the blockchain, not because it's trendy, but because it works. Let's imagine the world in 10 years. You buy an apartment without a notary. A smart contract does it all. You sell a car via a token, and its ownership history is stored on the blockchain, impossible to fake. Your medical record belongs to you, not the clinic. A bank account opens in a minute, Transfers arrive instantly, and the fee is less than a cent. And this isn't sci-fi. Much of this is already working, albeit with bugs and on small volumes for now. But remember, the banking system spent 300 years learning to be safe. The first banks went bust, and depositors lost everything. Even in aviation, they say, safety regulations are written in blood because every disaster birthed a new standard. Web3 is walking the same path, but in years, not centuries. And every hack here improves security, and every crash makes the code more reliable. The system won't replace old finance instantly, but it is gradually creating an alternative. And those who have already tried living without intermediaries are unlikely to go back. Because control over your own money and data is not a dream. It is a technology that works here and now. What do you think? Is Web3 a real alternative or just a new form of centralization? And can we even trust technologies that promise freedom but create new systems of power? Write in the comments. It'll be interesting to read your opinion. And if you want to understand the global economy, like this video and subscribe to the channel. So you're always one step closer to understanding how the world works. See you next time. Bye-bye.